Good morning, and welcome to the 19th Annual NYU KPMG Tax Symposium. My name is Larry Pollack. I'm a former international tax partner with KPMG, a graduate of NYU's Tax LLM program, and the proud director of this symposium. This annual conference brings together high-level government officials, tax law professors from NYU Law School, members of the bar, and partners from KPMG to explore and debate issues of current interest in taxation. The theme for today's symposium is Global Tax Roller Coaster, adapting to an environment riddled with complexity, uncertainty, and instability. This is an unprecedented and dynamic time in the history of international tax, both in the United States and globally. A confluence of the Tax Cuts and Jobs Act, which has transformed U.S. international tax, implementation of BEPS recommendations in certain countries, unilateral departures elsewhere, combined with a resurging debate with regards to the appropriate balance between source and residence jurisdiction, has fueled global tax complexity, uncertainty, and instability to levels not seen before. In fact, one might describe the current global tax environment similar to that of an amusement park experience, filled with adventure, fear, challenge, frustration for some, and for others, perhaps a sense of pleasure, satisfaction, and exhilaration. The symposium will focus on the practical implications resulting from the intersection, the interaction, and the clash of competing international tax policies and reforms. Our keynote speaker today will be John M. Samuels, Senior Managing Director and Chairman of Global Tax at Blackstone. Our distinguished speakers today include from NYU Law School, Professor David Rosenblum, Professor Daniel Shaviro, visiting Professor Georg Koffler, from Georgetown Law, Professor Itai Grinberg, members of the bar, Mary Bennett from Baker McKenzie, Kimberly Blanchard from Weil Gotshal and Manges, Chris Bowers from Skadden Arps, Slate, Meagher and Flom, Michael Caballero from Covington and Burling, Sam Maruca from Covington and Burling, Paul Osterhuis from Skadden Arps, Slate, Meagher and Flom, Deborah Paul from Wachtell Lipton, Rosen and Katz, Jeff Vanderwalk, Squire Patton Boggs, and Diana Wollman from Cleary Gottlieb. From the U.S. government, Brian Jen, Deputy International Tax Counsel at the U.S. Department of the Treasury. And from KPMG, Peter Blessing, Stephen Blau, Manal Corwin, Ron Dabrowski, Jesse Eggert, Sean Foley, Kim Azure, Michael Plowsian, Brett Weaver, Rob Wilkerson, Koon Ming Ho, Alfonso Palette, Chris Roberts, and Robert Vanderyacht. We will invite audience Q&A at the end of most of the sessions today. If you wish to pose a question, raise your hand and a microphone will be brought to you. But please note there are representatives of the tax press with us today. There will be two breaks, one mid-morning, one mid-afternoon, and a lunch across the hall in Greenberg Lounge, hosted by KPMG. Administrative procedures for claiming CPE and CLE credits. For New York State CPE, that is for the accountants, assuming that upon arrival you have signed in at the registration desk, you just need to submit your completed CPE evaluation form as you exit. At the end of the day, there is no need to formally sign out, unless you leave early and wish to claim credits for the sessions that you have attended, in which case you will need to sign out. To obtain New York State CLE credits, that is for the attorneys, assuming that you have registered in advance and upon arrival you have signed in and received a name badge. At the conclusion of the conference, simply drop your name badge in a basket that will be designated for CLE. There is no need to formally sign out. However, if you depart early and wish to claim credits for CLE, you will need to sign out at the registration desk. And for those who have not pre-registered, to obtain credits, you will need to sign in and sign out at the registration desk. Evaluation forms will be available at the registration desk all day. And the certificates for CPE and CLE will be emailed to you in about a month's time. Kindly put your cell phones on vibrate or silent, and let's begin with the program. Our symposium begins today with an analysis of the U.S. international taxing jurisdiction as it now exists under the Tax Cuts and Jobs Act. Given the 100% dividends received deduction, sometimes referred to as a participation exemption, available to domestic corporations with respect to dividends received from foreign corporations, but when combined with the expansive reach of the global intangible low-taxed income anti-deferral regime, what is it that we actually have? Do we have an expanded worldwide taxing jurisdiction due to the GILTI provisions? Do we have a territorial taxing jurisdiction due to the participation exemption? Or, holistically speaking, perhaps best described as a modified territorial taxing jurisdiction? And more importantly, how should it operate from a policy perspective? Our opening panel will be chaired by Paul Osterhuis, together with panelists Ron Dabrowski and Rob Wilkerson. From your left, Paul Osterhuis is of counsel with the Washington, D.C. office of Skadden Arps. Paul is well known in the international tax community. Paul is a frequent author and lecturer, has taught international tax at the LLM program in Georgetown, and has testified before congressional tax writing committees on various tax legislative issues. Ron Dabrowski serves as technical deputy to the principal in charge of KPMG's Washington National Tax Office. Prior to rejoining KPMG in 2014, Ron served in a variety of executive positions in the government, including special counsel in the Treasury Department's Office of Tax Policy, international tax counsel on the majority staff of the Senate Finance Committee, and Deputy Associate Chief Counsel International Technical at the IRS Chief Counsel's Office. Rob Wilkerson is an international tax principal in KPMG's Washington National Tax Practice, resident in Atlanta. Rob is a frequent speaker on international tax matters and appears frequently on KPMG's webcasts. Bob earned his tax LLM from NYU. Paul, over to you.
Thank you, Larry. Appreciate it. So I haven't been in a fun house for maybe 50 years, 60 years actually, and that was in Arnold Park, Iowa. So I thought, well, what does everybody think a fun house is? I looked up the definition in a dictionary. It's a structure filled with trick mirrors, shifting floors, and other devices designed to scare and amuse those who walk through it. So we're going to walk through the GILTI funhouse.
We could do a poll of who's scared and who's amused.
Right. Yeah, you can be amused if it's not your tax liability, I guess. But and what we're gonna do is talk a little bit about how GILTI is structured and whether that structure makes sense or whether different elements of it should be done in different ways. Because as I like to say, GILTI is a conceptual hybrid. And it is structurally clunky, if you will. It's a conceptual hybrid because it is in part designed to be a minimum tax, the kind of thing that we have had historically of assuring that you're paying a certain amount of tax or getting the benefit of a certain regime here, a participation exemption, but not too much. But it's also partly a tax on intangible income, a low rate tax on intangible income because of the theory that intangible income is mobile. And so it's really a conceptual hybrid to me, and it draws elements from both, and put together, they don't necessarily make conceptual sense. I suspect those of you who are teaching GILTI now have a hard time coming up with a principled way of teaching the concept of GILTI because it's not a clear concept. The second element of it is its structure. Instead of designing an independent structure for GILTI, GILTI was plopped onto subpart F in terms of the timing of income and the measurement of income, and onto our existing 904 foreign tax credit basket system, 904D, that was there to basically separate business income from passive income and not to do a lot else. So you have what I have described before as building a Ford F-150 truck chassis and putting it on a Mustang wheelbase. And Treasury has been trying very hard to come up with welding devices to make sure the thing can go down the road, but it is pretty clunky as it moves forward because the framework within which it has been put doesn't necessarily fit GILTI. So we're going to talk today about a number of specific elements of the GILTI regime and about whether they make sense and what can be done to make more sense of them. Let's start with the question of whether GILTI should be thought of or should be redesigned to be more of a minimum tax or more of a tax on intangible income. And I'm going to ask that of Ron first.
Yeah, so just to start out, I think as we sit here today, GILTI, despite its sort of hybrid nature, probably leans more toward an intangible income tax, that it is, and broadly defining intangible income and subjecting that on sort of an anti-abuse basis. And as we'll go through, a reformed GILTI might look better as a minimum tax, and we'll compare those two. But just to set out sort of what the two themes are, what do you mean when you say a minimum tax, and what do you mean when you say an intangible tax? A minimum tax really looks to the tax rate in the foreign jurisdiction and decides along some measure whether the income is high taxed or low taxed. If the income is high taxed, however you want to define that, it'll be exempt. That'll be the way we get into sort of our territorial regime. If it is low tax, well, that's not good, that's a bad class, and we will subject that income to immediate U.S. taxation. Kind of similarly, the intangible tax rules or intangible income rules would try to divide the world between good and bad, but the focus here, the dividing line, is extraordinary returns. So it's extraordinary returns at the CFC level. It must be that our transfer pricing 367D rules, Section 482 rules weren't working effectively. Something's gone wrong, and now we need to go tax that income again, or tax that income in the U.S. immediately. So big picture, trying to divide sort of good and bad in different criteria to do it by. The other big picture design feature that's in play is, how do you want to scope this? How broadly do you want to make this tax regime work? There are two dimensions along which that's sort of played out in policy. The first is, how are you going to top up the tax? So what rate are you going to impose at the shareholder level? GILTI takes a sort of 50% of the 21% corporate rate baseline as its norm. So it's topping it up, but at a favored rate. Perhaps, from the policy standpoint, the U.S. is looking out at the world, seeing mostly territorial regimes, not much in the way of worldwide regimes, and so to provide a competitive balance, we will tax, but not at the top line rate. Fine. The second sort of dimension is how much do you include in the base? So whether you have a minimum tax or you have an intangible tax, how much CFC income are you actually capturing? And you can make the provision, sort of more anti-abuse and narrow, if you have a relatively low minimum tax rate, or you define intangible income narrowly. Or conversely, you go in the other direction, have a higher rate as your threshold for low tax, or broadly define intangible income, and you will collect more. It becomes much more of a normative tax. GILTI here, again, a little bit mixed up. It goes one way for the tax rate, but its base is very broad. It imposes an intangible tax on mostly all the income of a CFC. Its ordinary income is defined based on QBI. Relatively now, and I think many companies are seeing that base as being quite broad. So, those are the parameters that we're going to talk about. And the other thing to note as we go through this, all of these design choices are intertwined. Like they all relate to one another. You can't sort of view any one decision in a vacuum. It has to be, you almost have to tweak a piece of it and then look at the whole and make an assessment. A very challenging sort of policy design.
Bob, any follow-up comments?
No, I agree with that.
Well, I have one, of course. I mean, to my mind, having it as a tax on intangible income because somehow intangible income is more mobile, I think that's the rationale that's given, is just a faulty premise. Tangible income is mobile too. In fact, now in the political arena, some folks are complaining that the QBAI, 10% of QBAI exception encourages you to move tangible property investments abroad. And when you look at companies that make huge tangible property investments, I think of Intel as an example. They certainly take tax planning into account when they're spending $2 billion on a wafer fab, and they would be the first to admit that. So I don't see that there's something particular that needs to single out intangible planning versus tangible planning, particularly now that our transfer pricing rules, I would argue after the 2017 Act, make it pretty hard to say you're moving intangibles because transfer pricing doesn't work. So I would think that GILTI should be seen as a minimum tax where it is truly, yes, we like you to have an exemption on your foreign income, but only if you don't, quote, abuse it, only if you don't do too much of it, kind of like the corporate minimum tax used to be. With the financial statement preference. You can use the tax preferences, but not too much. And that would allow us to simplify it a lot. It would also allow us to look primarily at foreign tax rates and take it from there. The second question is who is subject to the tax and who should be subject to tax. So Bob, let's have you take the lead on that.
Yeah, so as you said, the GILTI regime was really plopped onto our existing Subpart F rules, which were actually amended at the same time that GILTI was being added to the system. And so the way it generally operates, of course, is it identifies United States shareholders, those owning 10% or more of a foreign corporation, and determines whether they collectively own 50% of the corporation. That test used to require voting ownership by United States shareholders and no longer does. So that test can be met just through value ownership now. So it's expanded who is subject to Subpart F generally, and then by extension to GILTI as well. One of the key features of the Subpart F ownership rules is the constructive ownership rules, and they obviously can apply pretty broadly. And I think the big issue that I see with those rules now is the repeal of Section 958B4, which formerly prevented downward constructive ownership from foreign parents. The 958B4 was repealed, and so that rule no longer applies, and really expands the scope very broadly of GILTI to cover companies that wouldn't have been covered in the past as CFCs. And so those rules, to me, generally the concept of having a controlled foreign corporation and identifying significant shareholders who ought to be subject to it seems like the right approach for trying to apply a GILTI regime. There are a variety of things with the constructive ownership rules that one could challenge, rules dealing with partnerships and so on that can be traps for the wary and unwary, but also the scope of downward constructive ownership as well.
If they fix 958B4, which who knows, but if they do, and even if they don't, if you if you have a minority interest in a foreign company that doesn't have other, doesn't have the downward attribution problems, then under the regime, then because GILTI doesn't apply to you, and yet you get the participation exemption, don't you kind of have the best of
Yeah, I
worlds?
think that's the best thing going nowadays is
Yeah.
49% ownership in a foreign corporation that has no U.S. owners, which is rarer and rarer nowadays. But that's the best thing going, no taxation, and you could certainly see a regime like that that would maybe reduce the threshold for being subject to the tax,
Ron, what?
25% or something. Yeah.
Yeah, the only other aspect I think would be interesting to look back to is sort of our original Subpart F rules that said, unrelated U.S. shareholders can get you into CFC status. Like I, would have thought in the corporate context there ought to be, corporate control by, related corporations can create CFC status. And then after that, once you have control, maybe we can extend to other shareholders. But, having unrelated U.S. shareholders all owning less than 50% and creating CFC status, an interesting design choice, obviously not revisited, but something that could be revisited, I think, in other forms or for round 2 of GILTI.
Right, and I think all this ties to what we're going to talk about later with the treatment of capital gains, because 1248 only applies to CFC and not to non-CFCs, and that's a problem if you own less than a majority of the shares. So next, Bob, on who is subject to tax form, the low tax CFC definition and other design options.
Right. Well, so defining a low-tax CFC, you have to identify what the rate is, the minimum tax rate that you're targeting. We just suggest here 10 to 15%. That seems like the right. Obviously, GILTI is intended to be a 10.5% tax, 10.5% rate of tax on GILTI earnings. FDII earnings 13 1/8. So that certainly seems to be the right range. It's consistent. We'll talk a little later about the OECD proposals in this area or developing ideas in this area. That seems to be the rate that they're targeting as well, and seems appropriate also.
Yeah, I do think there's a trade-off between the haircut, the 20% haircut, and the rate, which is translated through the 250 deduction. But because you could have a smaller haircut and a higher rate, or a larger haircut and a lower rate, all of which has different incentive effects. So any of the economists in the room, Marty Sullivan in particular, you might want to think about whether 20% and 50% is the right combination from a behavioral perspective.
Yeah, and the slide notes the sort of design options. One could have the regime we have, or effectively the regime we have now, that GILTI income is fully includable, let foreign tax credits sort of take care of getting the tax rate right. And that seems a reasonable system if your foreign tax credit functions properly. Of course, expense allocation is the big issue there we'll talk about in a minute. The other possibility is just letting the local rate determine whether or not income is subject to tax at all in the U.S., a true minimum tax that would say if income is taxed at the appropriate rate locally, there'd be no inclusion in the U.S. And that certainly seems that is more of a minimum tax, a pure minimum tax approach, and not the one taken.
Yeah, and the other design feature there is just, do you look at sort of the local tax return and take their income number and their tax number and be done with it? That's certainly the simplest. If you're a little more skeptical that, the other jurisdictions might have undue deductions or that might not be reliable, then you look to the U.S., you apply the U.S. tax base and look at the foreign taxes paid and compare those two. Very sort of differing, differences in jurisdiction, tax bases and approaches, timing differences come into play. But a lot of it's just sort of like trust. Like if you don't trust your trading partners, you'll use your own income base and look at the actual taxes they pay. That's another very interesting, I think, design choice.
Yeah, I have to say the whole debate about per country versus aggregate, obviously we ended up with aggregate and GILTI. is one that is more about labels than substance, because I really don't think a per country can work. You can't use the local tax base or people will game the system to death. Everybody agrees with that. OECD agrees with that. You have to use your domestic tax base as the base for measuring the effective tax rate in the foreign countries. And all of our tax systems are different, even in high tax countries. We testified on this in OECD, but in the United States, you know, we're stupid enough not to exempt capital gains from the sale of corporate stock, and we alleviate that by giving a 338 election. Nobody else gives a 338 election that benefits the buyer, but we do that because the seller is being taxed. And so there alone, you have a huge mismatch. The Germans would see the sale of shares as not giving rise to income, and therefore there's no tax on it. That would be fine. But they would see the 338 election as making the U.S. a tax haven. Now, sometimes it might, but most of the time it doesn't, because the tax has already been paid by the seller. Stock options is another great example. The Germans give you a Black-Scholes type deduction for stock options when they're issued or when they vest. We give it to you when they're exercised. And those numbers are going to be quite different, obviously. And yet that doesn't make us a tax haven if the company ends up having very profitable stock options, or them a tax haven if the stock options never end up being worth anything except through the Black-Scholes model. So that type of mismatch of tax base will cause all kinds of problems if you're trying to do a country by country, and an aggregate approach or an overall approach for large multinationals at least tends to moot those problems. I think a lot of folks say, well, we should go to per country because they're thinking of the per country limit as it existed before 1976. Well, I'm one of the few people who was around in tax practice before 1976, and I can tell you it didn't work. It was at the holding company level. It didn't look through to companies underneath it. And so you could aggregate yourself to an overall level by just having a Dutch holding company on top of your structure. So that is a meaningless precedent in terms of how it would have to work. All right, that's the end of my spiel. All right, so Bob, back to you on the treatment of high taxed income.
Yeah, so this slide is just illustrating what is just a real anomaly in the existing GILTI rules and how they relate to the Subpart F rules. If we think of GILTI as a minimum tax, then income that is subject to a certain rate of tax should not be taxed in the United States. But under GILTI, because it requires full inclusion and lets the foreign tax credit work out, deal with getting the rate right, there are problems that can arise, particularly due to expense allocation, and that's all this slide is really illustrating. Simple fact pattern of a CFC with 1,000 of income and 200 of foreign tax, so a 20% rate of tax. So its income is high taxed by GILTI standards or Subpart F standards. It's taxed at a 20% rate. It has to be included in the U.S. There's $100 of expenses allocated to that, resulting in a residual tax liability of $21 in this case. And you compare that to the Subpart F result. If this particular income were Subpart F income, because it's high tax, the taxpayer could elect the high tax exception and exclude it from Subpart F and avoid taxation altogether. And so the existing system is encouraging taxpayers to try to sort of in a perverse way to restructure operations to create Subpart F income, the less favored category of income, to create that income to get a better tax answer. And it's hard to see that as anything other than a pure flaw in the system. So.
Just part of the fun house.
Exactly.
Treasury has been asked by, I think, a number of different sources to create a high tax exception for GILTI income that's not eligible for 954B4. Any reaction to that, either one of you, or any thoughts on what they should do? I take it the idea is to help you on your interest allocation, Bob, just as you were showing, because it would change your 904B4 apportionment.
Yeah, I mean, certainly there have been articles written on the kind of ways to find regulatory authority for it. I think it's sort of interesting. It is a pretty big leap, given that there weren't any real changes to the Subpart F regime. in tax reform. But nevertheless, I think there are some credible arguments out there, and I think Treasury is giving them a long look and seeing, trying to wrestle through their own, do we have authority and can we make this kind of manageable exercise? It'll be interesting. A very big change if we have a general, broadly applicable high tax exception. Tax reform starts to look much different at that point.
Yeah, it's not clear how many companies it would benefit because you have to be able to pull 18.9% or higher taxed income and assets out of your interest allocation calculation without actually starting to pay GILTI tax, right? You have to have enough excess credits left in your GILTI basket that you can pull those credits out, right, and still have it work. But if any of you are with companies for whom this would be an important improvement, I would suggest you weigh in with the Treasury Department because I think that could help.
It also just gets interesting when you create this, if you create an exemption based on general high tax, under the current thinking, you create much more exempt assets, your expense allocation changes, FDII policy starts to come into play. All that interest starts to look for what's non-exempt, and that goes back onto FDII, which is an interesting sort of trade-off.
Okay, next question. So if GILTI is really more appropriately seen as a minimum tax base, why do we still need Subpart F? Should we just get rid of it? I mean, obviously, to some extent, it can serve as an affirmative planning device. There's no doubt about that.
Right. We need it to make the system more sensible.
But apart from Subpart F as an affirmative option for taxpayers, is there a reason for keeping it around?
Yeah, I mean, I think the opening bid was sort of you'd come up with a new regime that would tax or not tax income and figure out the rates. But then Subpart F could be replaced in large part. That being said, I think there'll still be just passive income rules. Like you just can't let the bank account move from the U.S. overseas and get a 50% tax break. Like that's not going to happen. So you need the passive income rules. You need the rules that protect otherwise passive income that's attributable to an active trade or business. Fine. But now we look to foreign-based company sales and services income. It's hard to see, and we've seen and just discussed sort of, in some ways it looks better than GILTI income now. It's hard to see why it looks differently sort of from a moral or tax policy perspective, why it should be subject to a higher rate of tax, why it should have different foreign tax credit rules. Like it just is a sort of relic that can go away and would bring in just a lot of simplification.
Yeah, I mean, I think also just the base company rules themselves, focusing on particular country of organization, just don't really work in today's sort of economy. Companies are doing business all over the place, so those rules just don't, to my mind, make a lot of sense anymore, and ought to be coordinated better with GILTI. And as you said, there ought to be active financing exceptions and things like that for passive income. Those rules themselves, I think, still could be improved so that they would better define active income that escapes Subpart F taxation. But anyway, I agree with the point.
I would agree with that. Not just with active finance income and active insurance income, but also active rent and royalty income because of the legal entity restrictions they have in them on employees and things like that are kind of archaic in the 21st century. Seems to me there's a lot of work that could be done to separate truly passive income from active businesses that happen to get certain types of income that in some other circumstances are passive.
One of the items on there was 954C6 on that slide, I think. I mean, I think that'll be a big one to watch out for. Section 954C6, the look-through rules are scheduled to expire the end of this year, and it'll be real interesting to see whether those get extended. And companies have had different views about whether they want them to be extended or not, and that all plays into the interaction of Subpart F and GILTI. And if Treasury were to come out with rules that provide an effective high tax exception for GILTI income, that would certainly change the way companies think about Section 954C6.
From a policy point of view, it makes no sense to have 245 Cap A and not have C6, right? So, but that doesn't mean Congress is going to do anything about it.
Yeah, and right, dividends and deductible payments are
Right.
two different items.
Okay, second question for you, Ron, on this front is should guilt, they designed GILTI, and this was really a fundamental, probably joint committee decision, to get the lower rate effectuated through a deduction rather than through a separate scheduler tax like the UK has or like the alternative minimum tax is. Seems to me that fundamental decision caused a hell of a lot of problems. But what do you think?
Yeah, that's a good way to phrase it. It's interesting sort of how they got there. A lot of, we talk about GILTI, but you really can't consider it without looking at the FDII rules and sort of we want all foreign market income to be taxed at broadly the same rate. So, are you going to do a scheduler system, sort of a separate calculation onshore for FDII income? Well, maybe it's easier to just do a deduction. We're certainly more accustomed to that from the 199 experience, perhaps. It's just interesting which way causation sort of ran here. But it is, our GILTI regime does sort of run like Subpart F. It just plops into the U.S. tax return. We have QBI adjustments to get to the appropriate rate. We have the Section 250 deduction to, ultimately get you to a 10.5% effective rate. The world would be a lot simpler to take that lump of income and subject it to a rate of tax, whatever you think is the appropriate rate of tax, and put that on your return. Again, sort of a side calc almost. The other issue that comes up here is just the treatment of losses, both onshore and offshore. Here we have the Section 250 deduction. Under the current GILTI regime, it competes with onshore losses, and it loses to onshore losses, so you don't actually get the benefit. You will use onshore losses against GILTI income first. Similarly, sort of offshore, big issues on just how do you treat losses? Is it a consolidation regime? Broadly, GILTI does do loss consolidation. The other way to go in the loss space is that if I have a loss in a CFC or overall amongst all CFCs, should I have a rule like Section 172 that carries the losses forward? And so it's more of a normative tax base over time. We didn't go there. So a lot to get into here on separate versus not. I would think more separate and, a 172 notion offshore would make more sense than sort of where we are today.
Bob?
Yeah, I agree with that. I think a regime that doesn't allow NOL carry forwards seems inconsistent with a regime that also doesn't allow foreign tax credit carryovers in the U.S. There just are timing differences that are sort of pervasive in U.S. versus foreign taxation, and those obviously get reflected. We're going to talk about foreign tax credits in a minute, but I think that those sorts of timing differences are the problems of those are exacerbated with the GILTI rules as they're written now.
Yeah, this is an element where GILTI really is a hybrid that is very frustrating because it's not a CFC, it's not purely a CFC deemed distribution regime like Subpart F because you have several shareholder attributes that you have to deem up: QBAI, your interest income, your interest expense, your foreign taxes, your losses are all taken into account at the shareholder level. And so it has elements of a pass-through regime with respect to those items, but it's not a pass-through regime beyond that. And so you're left into this kind of mishmash, if you will, of that we tax lawyers are not used to because it takes elements of both. And if you were to change it to a minimum tax, I mean, part of this was our own dealing in the business community because we wanted losses to reduce GILTI, and there were a lot of taxpayers who very much wanted QBAI to be determined at the shareholder level so that the taxes that are paid in the jurisdiction where you have your tangible property investments are averaged with the taxes that are paid in other jurisdictions and not pulled out on a tracing basis. The theory was, at least for some taxpayers, that there was a correlation between their high tangible property investments and high local tax rates. and a correlation between low tangible property investments and low tax rates. So they wanted QBAI to pull out taxes at the average rate, not at the traced rate. And so to some extent, the complexity was of our own making, but I think the system would be a lot better. And of course, if you got rid of QBAI, then that wouldn't have to be a consideration. It would be a lot better if we could push it back into being more of a deemed distribution regime rather than the mishmash. Now, what about on the foreign tax credit side, Bob?
Yeah.
We talked somewhat about that, but.
Yep. Well, some of the issues that come up and are listed on the slide here, a big question we've touched on is viewing GILTI as a minimum tax. Should foreign taxes be measured on a CFC by CFC basis, per country basis, or full consolidation basis? Again, it seems to me this sort of involves answering a lot of other questions at the same time. I was interested in your comment earlier about per country not working. I sort of see that in the foreign tax credit. That doesn't make as much sense to use a per country limitation in the foreign tax credit. If you had a true minimum tax, though, where a certain rate of taxes is achieved, then income's not taxable at all, a per country system does make more sense to me if part of the thought process is we want to, the minimum tax is designed to encourage or to discourage tax rate shopping. And if you don't do a per country test, then you certainly allow companies to then move profits out of higher tax countries into lower tax countries, it seems to me. So I think a big question is, do you do foreign tax credit or just a pure minimum tax? If in the foreign tax credit world, we have this 20% haircut on foreign taxes for GILTI purposes. And I understand that to be intended to encourage companies to try to minimize foreign tax, to have some skin in the game on that. That I don't see in practice really influencing companies much at all, the 20% haircut. So it just seems to be a design feature that doesn't make a lot of sense to me. We've already talked about carryovers.
Yeah, let's go to expense disallowance here, because that's an important element.
Okay, yep.
Go ahead.
Yeah. So foreign tax credit care, there are no carryovers in the GILTI world. And as we touched on earlier, I mean, I think that timing differences mean that that the absence of carryover rules can make a big difference. The reality is at the rate that we have for GILTI, I don't see the carryovers being as much of a problem as expense allocation, creating excess foreign tax credits in the GILTI basket. So, and then expenses, I think the next slide was going to talk about a little bit.
Yeah, I mean, on expense allocation, I think we're going to have some progress being made by the Treasury Department in terms of R&D being allocated to the general basket under the sales method, because after all, that's where royalties are, so that makes a lot of sense. Stewardship, it's been interesting to me, I haven't seen that many companies that exercised about the allocation of stewardship expenses. Maybe that means everybody's gotten them down to a small enough number that it's not that material, but I think there's a good argument to be made just kind of on a parallel basis with R&D that stewardship jobs are good jobs. Why would you want to be disallowing deductions for those expenses when you can't be charging them? By definition, you can't be charging them out. On interest, it's a different issue, right? Because we don't have, unlike R&D, we don't have a 367D that keeps you from pushing your capital into your CFCs. And of course, most people do it with equity, not with debt, because why pay 21% tax on your interest income with your intercompany debt when you can pay a lesser rate of tax in a foreign jurisdiction? So I don't know, Ron, what do you think about the interest allocation regime?
So for foreign tax credit limitation purposes, I mean, there are a few different angles that might be worth exploring. I think we've had some discussions on aligning like financing businesses, stronger tracing rules, if you would, for interest expense to financing businesses. That's sort of one place it could go. Otherwise, it's certainly a big design issue. I guess I would rather see the regime move more toward the minimum tax, have less inclusions and less reliance on a foreign tax credit system. On that note, I will say, if you make the regime much more anti-abuse, right? Say it's a minimum tax at a 10% level, the argument for having a foreign tax credit becomes an argument. I think it becomes more tenuous. Do you really need a foreign tax credit regime if it's more targeting, don't go to the non-developed, no taxation jurisdictions or the jurisdictions giving tax breaks? If it's below 10%, we're going to view it broadly the same way we treat high state taxes, nice deductible thing. Would take a lot of the complexity out of the regime. Obviously, all this would have to mix in with treaty policy, and you could consider whether treaties would allow a credit on a bilateral basis. But what should the norm be? I'm not sure if you make it more anti-abuse and skinny down the scope of income subject to it, that you still need a foreign tax credit regime.
Bob, any?
Yeah, well, I agree with that. I mean, I think that when I think of a minimum tax, I mean, it strikes me that once you have identified your appropriate rate of tax, then there's no reason to apply the foreign tax credit rules. That just then gets you back into sort of dealing with U.S. shareholder level NOLs and other attributes and so on, and that seems inconsistent with the purpose of the minimum tax.
I would just have one note of caution to everybody who complains about interest allocation under the existing GILTI regime. We didn't get Section 163N. We almost did, right? It was in the House bill and it was in the Senate bill, and they dropped it in conference. And my impression is that part of the reason they dropped it in conference was because of revenue picked up from expense allocation covered the revenue that otherwise they might, at least a portion of the revenue they otherwise might have picked up. And we all would have been worse off. We would not have had any problem with the GILTI rate on interest allocation if we had 163N, because with 163N there's no need to allocate interest for foreign tax credit purposes. 163N forces you to push your debt down into your foreign affiliate structure. And so the question is, and that would be worse. So, the question is, however much we want to push on minimizing interest allocation for GILTI purposes, that's fine, but be careful if it ends up being too generous, then it might tempt some politicians to resurrect, particularly on the Democratic side, to resurrect 163N and another round of tax reform, because people will still be able to, quote, double dip by borrowing in the United States, equity funding Luxembourg, and then lending to France and getting 2 interest deductions. So, and having the income come back on GILTI with excess credit. So you really have to be careful on how much you want to criticize the interest allocation, even though it does violate what the conference report said about having no GILTI tax if your rate is 13.125%. Okay, now on to one of my favorite bugaboos is the anomaly between gain on the sale of CFC stock and the 245 Cap A exemption. It creates all kinds of anomalies. What it means is that if you have loss transactions, you want to sell shares, but if you have gain transactions, you want to sell assets. And obviously, we have tools in our toolbox to help us satisfy our clients in determining which we sell through Check the Box, through 338, and other devices. So, Ron, first of all, does it make sense to not exempt capital gains on the sale of shares and deny capital losses on the sale of shares if you're going to give a 245 Cap A exemption? And does it make sense to give us the electivity if we're not going to do that?
Yeah, I mean, this is the ultimate funhouse, right? Your stock gains and losses is in a 21% environment, a 10.5% environment, or a 0 environment, and you have a lot of control over which that is. And technical corrections might change some of that, but a remarkable amount of discretion in here and planning. And again, unlike sort of the way the rest of the world operates, right? The rest of the world says, we'll give you our participation exemption regime, we'll give you 95 or 100%, exemption on the stock sale, and there's no basis step up inside. We tax at the stock level and have an elective, do you want to get taxed at the asset level? And just a fully insane regime. I mean, the solutions might well be, I think of it as sort of like the automatic 338. Like if there is a qualified stock purchase, however you want to define that, you force the asset sale and the basis step up down below, you effectively tax the gain on the appreciated assets. That's really what we're talking about here at the CFC level as GILTI income at the shareholder level, and the system trues up. It's very akin to sort of the wars that have happened over time on 754 elections and sort of how the partnership regime should true up. But given we are in practically a worldwide system, there is a certain analog there.
Yeah, I mean, I think it's hard to justify from a policy perspective sort of treating identical transactions differently just based on elections, 338 elections and check the box elections and so on. But I will say it does make tax planning a lot more fun.
Well, and the mandatory 338 is something that that I think I've been on record recommending for a while. The one problem with it that we all have to admit is that it still creates an anomaly with foreign jurisdictions. So, if my CFC is buying a German company, Germany's not going to tax a gain on the sale of shares because they assume I'm taking it with a carryover basis, and yet I can take it with a 338 election. And so you kind of, it is a major, double non-taxation fact pattern that would still exist. And so maybe that means we'd be better off conforming with everybody else and just exempting gain on the sale of shares with a carryover basis to the buyer. I don't know. I think it's worth thinking about. Okay, now one of Ron's favorite subjects and something that he and I have debated. Why the hell do we need PTI when we have 245 Cap A? Ron? You want to start, Bob?
I'll let Bob start.
Okay.
He's more tempered in this.
You have 6 minutes to talk about this. I love it.
Okay, just in the interest of time, I mean, I think the system we have now is one where the GILTI rules are as Paul said, plop down into subpart F. So GILTI inclusions create PTI, basis adjustments for the inclusion, and PTI. And then for Section 245 Cap A dividends, the exempt earnings, those are just remain earnings and profits at the CFC level when they're distributed up. There are no basis adjustments. They're treated as dividends under the normal Section 301 rules. And so I think the next slide sort of talks about is that the right system? Should we keep the PTI rules at all or get rid of them? And I guess my view is that the PTI rules really don't make a lot of sense in a world where you have an exemption system sort of at the base of your CFC taxation. The basis adjustment rules, I mean, we have, Ron and I and others in our group have just some of the most vigorous debates we have about how the PTI rules actually operate in certain cases. The per share basis adjustments and so on just create a lot of friction in the system that really shouldn't exist. And so it seems to me that in a world like we have now, there's not a need for a PTI system to track those earnings anymore, that instead one could either just exempt distributions, period, all distributions out of PTI and non-PTI, or what seems to me to make even more sense is a deemed distribution recapitalization type approach that treats earnings as distributed and recontributed, creating basis for those earnings in that case and getting rid of E&P. But the PTI rules just don't seem to me to be as relevant as they were in a system where you had sort of subpart F viewed as a current advance tax on earnings before they're distributed. It makes more sense. And the other issue that was floating around there was Section 986C. That makes some sense in the prior world where subpart F was an advance tax on undistributed earnings. Distributed earnings are taxed fully in the U.S. based on prevailing exchange rates. 986C makes more sense in that case to true up or down currency results, but in the existing world doesn't seem to make sense anymore.
Boy, we should have just a separate panel on this topic.
everybody
To my mind, it's much more about, and Bob sort of raised the point, should you have distributions creating shareholder level tax in this regime? You know, I just tend to think not, or that it should be more rare. I think we can all agree at least that the current regime that mixes PTI and 245A is broken. For me, the clearest part of that is it's broken because of losses. I can have a loss in subpart F, and it effectively wipes out my exempt income. And so I will have return of basis and gain quicker than I otherwise would have had. The world could work if you just take all the earnings and make them PTI with basis adjustments and allow them to come out, or you make all the positive earnings 245A and let them come out. There's a little bit of timing difference in how you stack losses, but either would sort of be better. Where it is now is broken. And the other big issue is sort of 960B. You know, when I've taxed down below and then I have taxes imposed on distributions, a 245A, you don't get any more credits policy, doesn't quite seem right to me. So, you know, you have to.
Those credits could just dump into a GILTI pool. I mean, if we didn't have GILTI credits with the relationship notion that's in 960, that just your residual credits, like used to happen before 2018, would just be in the general basket back then, so they'd be in the GILTI basket now.
Yeah, you could do
could have the
timing
taxes
and
on
carry them. You'll still need the
PTI.
mechanics at least.
Yeah, and admittedly, you'd get the haircut, but you know, it seems to me that's close enough. And I totally agree, 986C. We don't do it for C6 distributions out of foreign functional currency companies, right? So why do we do it for PTI distributions in a world today? And if you gave up those two things, you probably have given up most of the reasons for having to track what is now, the 10 categories of PTI that's in the regulations. So.
Do some Q&A.
Well, we got one more slide, sorry, and that will just take 30 seconds. Whoops, here we go. Just a note that the OECD deliberations with their Pillar 2 is talking about, you know, a minimum tax. And to my mind, how that comes out is going to be important, because a lot of these issues, I think, are going to be on the table legislatively in this country sometime between 2021 and 2024. And what OECD says about a minimum tax like this compared to GILTI, particularly on things like a per country versus an overall, will inform the legislative debate as it happens in this country. So I would urge you to keep an eye on what's going on in Pillar 2 and not spend all of your time, as we will spend a lot of time later today on Pillar 1. So with that, any questions?
We're not done yet.
Nope. We finished ahead of time, Larry. Don't we get a gold star? Thank you all very much.
Got one question.
One question.
Oh, you do have one. Okay, good.
Given all of the anomalies and what-ifs that this discussion gave us, how likely is it that we're going to see some immediate legislative changes to reflect the sense of some of these suggestions?
Ron, you used to be on the Hill. You probably have some.
Yeah, I think the OECD process goes first, and it's sort of see what the rest of the world does. I think ultimately design features have to sort of reflect on what the rest of the world looks like, if the rest of the world's territorial versus how well BEPS is working, versus if Pillar 2 comes into play. But, you know, legislation just as a practical matter, not happening quickly and not going to be robust. So we'll see. We've got a long way to go to get to that.
On that note.
Thank you.
Anything else? Okay, thank you.